Hello, everybody. Our attendees are coming on in strong. It's great to see everybody here. Let's make sure that we have open lines of communication to kick off this webinar. I'd love to hear from the attendees. Let's go down to the chat button in the bottom left-hand side of Zoom. Click in there and tell us where you're from today. Where are you coming? Where are you listening to us from? I'm guessing we're going to have people all over the country, but I am curious.
Hey, everybody.
There we go. Dan, good to see you, my friend. All right, Salt
Great
Lake
to be with
City,
you.
Omaha, Nashville, Charlotte. All right, we were right. We're getting people from all over the country. So mission accomplished there. And thank you, everybody, for being here. Welcome to Tariffs, DOGE, and the rising odds of an economic recession. This is something that is likely on everybody's thought process and has some people concerned. And I don't know anybody better to guide us through this really historic moment in time with everything that's going on than Dan Habib and the MBS Highway team. Now, Dan is the chief market analyst for MBS Highway. And MBS Highway is the prestigious Crystal Ball Award winner, not once, not twice, not three times, but four times. The Crystal Ball Award is awarded by Pulseonomics and there's over 100 economists, real estate experts, and people who prognosticate about the real estate and mortgage interest rate markets. They submit at the beginning of the year their forecast of where mortgages are going to go and where the real estate market's going to go. And MBS Highway team has won that prestigious award four times. So when we go into a really hairy situation like we are now with things changing so quickly and a lot of fear in the market, we want somebody like Dan to be with us to guide us through these times because they're the best. And I thought before I welcome Dan to the stage here, I just wanted to share a very quick article that somebody sent me yesterday. This was on CNBC, and the point that really, the key point that really caught my attention here is a majority of Americans, 85%, have concerns about tariffs. A new NerdWallet survey finds. Other data points to plummeting consumer confidence. So I think that's important for us to understand as real estate and mortgage professionals that the conversation going on in the minds of our consumers right now has changed. There's fear, and when consumers have fear, they tend to pause. They tend to not move forward. So our job here today is to really kind of break this apart, understand all the moving pieces of what's going on and how it's likely to impact the mortgage interest rate environment and, of course, the real estate market. And that's what Dan is going to do here today. Dan, before I turn it over to you, I just want to say thank you to all the mortgage advisors here from Neo Home Loans who asked us to put together this event. Sean Antonius actually was out talking to a bunch of his realtor partners. This was like the number one topic on people's minds. And so to be able to bring this kind of advice to the real estate community is a real blessing. We're grateful to have you here today. And without further ado, Dan, what the heck is going to happen in the mortgage and real estate world? Over to you, my friend.
Well, Josh, thanks for that beautiful introduction. And, first of all, there's a ton of uncertainty going on, a lot of volatility. I'm going to do my best today to make it easy to understand, break it down, and really arm you with the knowledge and insights to help you calm your customers, to still point out the opportunities, to sound like an expert on the market and really increase your conversion, because even though things are volatile right now, oftentimes during volatility, there's opportunity.
Yeah.
And before I get started, Josh, it was a really nice introduction, but I just wanted to say a few words about your team. So first off, it's nice to see some friends on here. I see my boy Jim Jurgens, one of the best loan officers and smartest guys in the country, but that's a common thread with pretty much everybody at Neo. I get the pleasure and opportunity to talk with loan officers from every mortgage company in the country. And we're blessed to have relationships with many of them. And I can honestly say that Neo is special, and they are some of the best, most professional and smartest loan officers that I've ever had the pleasure of working with. And I think that I'm going to show you a lot of stuff today that I know you already probably think that they're great, but a lot of stuff today for the agents listening right now that your Neo mortgage professional can provide for you that I think you're going to be pretty excited about. It's going to make your life a lot easier. I think it's going to help you to increase your conversion and ultimately sell more homes and generate more income, which, hey, that's the name of the game. And that's why we're all here, right? So let's jump right into it. I'm going to share some slides. There's a lot I want to cover, so it's going to be a little fast paced. Listen, I know everybody has one of these, but if you could put that away, maybe take some notes. I promise I'm going to try to really do my best to add value here, but you're not going to get it if you're answering emails and such. So do your best to put it away, but I know it's not easy. I can relate. So jumping in here, people ask me all the time, Dan, Barry, and for those of you that know my father, Barry Habib, he's the CEO of the company, but people ask us all the time, what's the fastest way to increase my income? And while there's not exactly a silver bullet, I think one of the best ways is to just close more of the opportunities that you already have in front of you. If you think about it, you don't have to do all kinds of crazy extra marketing. I mean, all you're doing is being more effective with the opportunities that are already in front of you. If maybe you're closing 5 out of 10 people that you speak to, imagine if that went to 8, 9, 10. You literally double your business by just increasing your conversion. So how do we do it? Well, I think in any relationship, gaining trust is paramount. I mean, think about personal relationships. When trust doesn't exist there, it's a pretty rocky road, right? Things really get bogged down. It's difficult. But in business too. And how do we build trust? Well, there's many ways, but in my humble opinion, the 2 best ways are with vulnerability, pointing out the things they should be looking out for. Being vulnerable, it's not easy. Sometimes you might think that it could be perceived as weakness, but man, I can tell you firsthand, being vulnerable really helps you to connect with people. And the other one is expertise with wisdom and with knowledge. But you can't give what you don't have, right? You can't fake that. But we know, and just look at yourself and the relationships or people you choose to work with, you're drawn to people that you perceive to be an expert, people that are masters of their craft, people that have put in the work. So I'm going to try today to really, in a concise way, give you some of that wisdom and knowledge to hopefully help you in your conversations with your customers. But I think wisdom and knowledge and market expertise is one of the best ways to build trust. Now, before I get into where I see things going this year and give you an update on all the tariff mayhem that we've been seeing, conversations about people thinking Powell, our Fed chair, may get fired, let's first look at how we did last year. So we always put out our forecasts. And one thing that's difficult about that is that you're not always going to be right. It's like Yogi Berra said. He said, Yogi Berra said, predictions are hard, especially about the future. But let's take a look at how we did last year. So we thought home prices were going to be 4.5% to 5%. And boy, that was a bullseye. And remember, last year, so many people were talking about how home prices were going to go down. We were kind of like the only one out there on an island saying 4.5% to 5%. It came in right in between there. If you look at FHFA, 4.7%. If you look at CoreLogic, it was around 5%, Redfin 5%. And last year is one of the years that we most recently won the Crystal Ball Award. And as Josh said, this is for our real estate forecast. And I don't put this here to boast, but just to let you know that the insights that we're giving you on the housing market are pretty credible and pretty good. So this is Barry here, if you don't know him, with his 4th Crystal Ball Award that was awarded to MBS Highway. We thought the 10-year was going to be somewhere between 3% to 4.4% last year. We missed that by a little bit. The actual was 3.6 to 4.7 as the range. And we thought 30-year fixed mortgage rates were going to be in the mid-5s to high 6s on the high end. And actually, it got to the high 5s, the very high 5s, and the low 7s. So we missed it a little bit on rates. Boy, there was a lot of factors. I think one of the things is the jobs data just was very unreliable and coming out very, very strong, only to see it get revised much lower in the subsequent months. And I think if those numbers were reported correctly, we would have probably been a lot closer, because every time a jobs report came out, if you guys follow along, mortgage rates hated it because it was so strong. This year, there are more things going on in any year than I can remember, and we're only here in April. So it certainly doesn't make my job easy in forecasting, especially when the markets are moving crazy, wildly, and volatile on every headline regarding tariffs. And let's talk a little bit about the tariffs. So, first of all, the way that they did the tariffs, I think, was interesting. And before I even get into this talk, I just want to be very clear that I am not trying to get political. I could care less whether you agree with or don't agree with the way things are being done, are being handled. I'm just trying to explain this to you as far as here's the way I see it happening and how that could impact the economy, mortgage rates, and ultimately real estate as well. So the way that they came up with tariffs is they said, we're going to take a look at our trade deficit with all these countries, and we're going to divide that by the amount we import from them. And then we're going to say that's the tariff that they have on us. Now, a lot of people didn't really get this, and they saw these tariff numbers where Trump was rattling off how XYZ country has a 50% tariff on us. They don't really, in most of these cases, have a 50% tariff on us. But in their calculation, an example would be this. We have a $100 billion trade deficit with a country, and we import $200 billion. He says we have a 50% tariff. Now, whether you agree with the way he calculated it or not, initially what he did was said, okay, we're going to take the tariff you have on us, 50%, we're going to cut it in half, and that's the tariff that we're going to put on you. Now, conceptually, in my opinion, I do think that we could work out some better trade deals. If you look at a lot of the deals we have with other countries out there, they're unfair. And I know that's been the status quo, but it doesn't necessarily mean that it's right. And I think we do deserve to have some more favorable trade terms. A lot of countries have tariffs on us that we don't have on them. That doesn't exactly seem right. We're giving you access to our market. You're not giving us as easy access to your market. I don't think that it's feasible in a lot of cases to incorrect that trade deficit because you have a small country like Vietnam, no matter what, they're not going to have the GDP to be able to buy more from us than we are from them. I mean, it's an impossibility, right? So there's always going to be a trade deficit with them. And the tariff they actually have on us is very low. Now, nobody knows for sure, but maybe Trump's plan was to start so high with the tariffs and then pull them lower to the 10% baseline on all other countries that they are now, because people not only didn't retaliate, they kind of cheered that the tariffs were only 10%. But China is an exception. China, we have 145% tariff with currently, and they keep going back and forth with us. It's really just window dressing at this point. The truth is, once you get above 50% in either direction, it's like a trade embargo. It pretty much halts trade because it doesn't make sense. And then any increases or escalations after that, that's just optics. But there were some very exciting comments today, actually, that helped the bond market move higher and rates move a little bit lower. They've given back some of those gains. Boy, the stock market's really on a tear. It's given back some of its gains too, but the S&P is up over 2%, the Dow up 1.5%, and the NASDAQ up over 3%. Those are big moves in a single day. And tariffs are causing a lot of concern out there because, number one, if you look historically, they lead to recessions. And while they can cause temporary inflation, so long as there's not continued escalation and it's ongoing, it really is different than inflation, which is persistent and ongoing. It's a one-time price increase, and that certainly could influence the inflation numbers that we get. The most recent numbers we got were for the month of March, and even though they were really low, the market didn't really care because it was before the tariff. So the next set of inflation data that we get in the month of May, which will give us April's figures, that's really going to be critical to see how much it impacted that. But it, on one hand, can cause a temporary spike in inflation, but the other hand that people don't think about that much is it causes demand destruction. And that's why it really leads oftentimes to a recession. And we're already seeing signs of the economy slowing as a result. And Josh, you astutely pointed out that article there where it's something that is top of mind with businesses and consumers, the vast majority in the country. Today, we heard from President Trump and Treasury Secretary Scott Bessent, and they both hinted that they may cut tariffs substantially on China, which I think would be a good thing for the markets, and that is going to be in advance of their conversations with China, at least what they told us today, to maybe kind of warm them up a little bit and then try to put a negotiation together. Listen, I think it's in both countries' best interests to be able to come to a resolution here, because we do rely on each other for many, many things. And the longer this goes on, the more painful it's going to be for each country. Bessent said that he thinks there's going to be a de-escalation in the U.S. and China trade tensions. He said that a little bit earlier today. And I think he believes that's going to be happening in short order. So we may get some updates on this. Remember, with the 10% baseline that's on everybody else, that's for 90 days. So after 90 days, we're not quite sure what's going to happen. But there is a lot of countries, I believe it was estimated about 75, that have reached out to the U.S. and are coming to the table to hopefully put together some favorable trade deals. So it is a fluid situation. It has big impacts. I think the economy was already slowing before the tariffs. And I'm going to share some stuff with you to illustrate that and what I think the impact of these tariffs is going to be. The other big wild card out there that was really causing a lot of uncertainty that the markets didn't like is President Trump. And listen, I don't agree with exactly the way that he put these statements out there, but he clearly was not in favor of what our Fed, and especially Fed Chair Powell, was doing. He thinks they should be preemptively cutting rates ahead of a potential recession. Now, he said that he's a real loser, and he said that his termination can't come fast enough. So that is something that had the markets thinking, well, is he going to fire him? Is he even legally allowed to fire the Fed chair? And then if he replaces him with somebody that might be all about cutting rates, is that good for the economy or inflation? So that was removed today, where President Trump said he has no intention of firing Powell. He does have his term, Powell, running until May 15th of 2026. So a little more than a year or about a year and a month left in his term. But the Fed is in a tough spot right now. If you think about it, they have a dual mandate: stable prices and maximum employment. What does that mean? It means they want to see 2% inflation on a year-over-year basis. That essentially means they only want to see the price of goods and services rise by 2% a year. That's something they think is manageable, especially because incomes usually outpace that. And then they want to see maximum employment, which means they don't want to see the unemployment rate go too high. They consider full employment around 4%. Right now, it's recently been drifting higher to 4.2%. But the way they explain this, and I thought the Chicago Fed President, Austin Goolsbee, did a good job of this, where they were asked, which one's more important? Is it labor or is it inflation? And Goolsbee said they're both equally important. It depends which one's more out of balance. Almost like if you have two children, they're both your children. You love them both. They're both equally as important. But if one of them's really misbehaving, your attention's probably going to go more so there, at least for the time being. Same thing here. But Powell spoke last week, and he made some comments that led us to believe that, at least for now, inflation is more their priority than labor. So speaking of inflation, inflation is very important for rates and, in turn, for demand for purchasing real estate. We know how sensitive activity is to interest rates. What is some of the big influences of interest rates? Well, you have credit risk premium. As you all know, the worse your credit score is, the higher the rate, because you're a riskier borrower. You have term premium. The longer you're going to be borrowing the money, the lower the rate. If you have a 15-year versus a 30-year, right? The 30-year is going to be lower. So I'm sorry, it's the opposite there. The 15-year is going to be lower because you have a longer term as opposed to a 30-year. It's riskier because you're borrowing the money for a longer duration. So the shorter the term, usually the lower the rate, the longer the term, the higher the rate. But then the other big one that I want to get into a little further here is the inflation premium. If I were to say, Josh, lend me $100,000, and he would say, okay, maybe, I trust you, Dan, but I'm not going to do it for free. I'm going to charge you a certain interest rate. And let's say we put this in place for 30 years. So every month, Josh, as a part of our deal, he gets $4,000 in interest. And maybe initially, he can buy a whole list of goods and services. But if inflation is continuing to rise in the background, what happens? The cost of those goods and services is increasing. Yet the $4,000 he's receiving for the next 30 years, that doesn't change. So inflation erodes the buying power that Josh gets from the loan that he gave me. There's nothing he can do about that loan, but he could buy less because that amount is fixed while prices are rising. What is he likely to do if somebody else wants to borrow money? He can't change the loan he gave me, but If all of a sudden Jim Jergens said, Josh, I saw you lend Dan 100,000, can you lend me? He might say, yeah, but he has to raise the interest rate to combat the faster pace of erosion of his return due to inflation. And it's oversimplified, but that's pretty much how it works with mortgage rates and in the market. If inflation's moving higher, lenders are going to have to charge a higher rate of interest in order to combat the faster pace of erosion due to inflation. But the opposite's also true. As inflation's coming down, you almost always see mortgage rates come down. Now, Powell said last week, without price stability, which means inflation at their goal, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. So this is what I was alluding to, where it seems like, in Powell's words, that inflation right now is more important than the labor market. So it's really going to be critical to see what happens with the inflation numbers, especially once the tariffs are contemplated. I can tell you that other inflation measures out there, like Trueflation, which comes up with this stuff daily, is showing that inflation actually is below the Fed's target at 1.4%. But the numbers that they look at are consumer price index and personal consumption expenditures. They give you a monthly and a year-over-year inflation reading, and they're a lot higher than that. They're above the Fed's 2% target, but there's some problems with those reports. There's some big lags, and a big component is shelter. How much you could rent a home that you own for, or how much rent prices are going up or down. And they're not reflective of what's really happening in the market. It's beginning to catch up, but because it's not caught up, I believe it's artificially stating inflation as higher than it really is. And when you hear people talk about inflation coming down, you might say, Dan, I don't know what you're looking at or what you're smoking, but I don't see prices coming down at all. And you're right, they're not. We're talking about the rate that they are going up is decelerating. And if you look over the last 5 years, cumulative inflation is a real thing. Every year where you see these inflation numbers going up, unless you see a recession, you don't normally see prices go down. They only go up on top of those already existing increases. So the cumulative impact is significant and real. But the Fed wants to see prices not fall. They want to see them rise by only 2% per year. But that means things are still getting more expensive. So I just wanted to break that down. But our forecast for inflation right now, the Fed's favorite measure that they are looking at as their target to get to 2%, it's at 2.8. It was at 2.8% at the beginning of the year. We think this year it's not going to get to their target. We think it's going to come down to 2.6% at some point this year. The labor market, another critical one. The Fed may be somewhat more focused on inflation, but if you start to see that unemployment rate really shooting up, they're going to feel pressured to cut rates. And the latest numbers, the median duration of unemployed, this means how long people are on average, or I should say the median, the middle number, how long their unemployment is lasting, you can see how this has been going up pretty significantly. So that means to me that people are having a harder time finding jobs once they're let go because there's less hiring. And the job openings out there, they've been clearly declining. And this is even, in my opinion, overstated because after COVID, you have work from anywhere for a lot of companies. And you can put a job opening, a posting in 50 states, theoretically, if they could work remote. And there's a lot of double counting happening there. But even with that, you could see job openings clearly have been on a sharp decline. I'm already seeing signs of weakness in the labor market. The unemployment rate went from 4% over the last few months up to 4.2%. I think it's going to continue to rise. I think it's going to go up to 4.4% or maybe even above if we see a recession. And we're going to talk a little bit more about some of the indicators that we're seeing out there that are pointing to a slowdown in the economy. In my eyes, many people that I respect think that we're already in a recession. We just don't know it yet. And that the Fed should be preemptively cutting rates. But as I mentioned, the Fed's in a tough position because they're very worried about inflation. But on the other hand, hey, it looks like we may head to a recession. Why not start helping now? Because in Powell's own words, monetary policy, which means cutting rates or hiking rates, it has long and variable lags, which means if they start cutting now, you're not going to see the influence of that in the economy for quite some time. And the Fed historically has always been reactionary. If you look at the big inflation problem we had, where inflation went up to, on the CPI, around 9%, we had 40+ year high inflation, the Fed is culpable in some of the cause for that. On one hand, you had $5.2 trillion in stimulus, And when people get money, what do? They spend it, and that bid's price is higher. And on the other hand, you had the Fed, who after COVID was trying to stimulate the economy. So what did the Fed do? They bought a ton, trillions of dollars of mortgage-backed securities and treasuries. And by doing that, they artificially kept rates low. And the reason why they wanted to do that, when rates are low, money's cheap, people borrow, and it helps expansion in the economy. The other thing they did is they kept the Fed funds rate at zero for too long. If the Fed stopped buying earlier, and if the Fed started raising rates earlier, they probably would have quelled at least a decent portion of the inflation we saw. But they were late. The reason they were late is because the reports that they're looking at are backward looking. There's big lags in the CPI, the PCE, as I was explaining before, and they're not really looking several steps down the chessboard, at least when it relates to this. So many people out there questioning all the things we're seeing and the tariffs, which is going to cause demand destruction and a slowdown, and some would argue already in a recession, that the Fed should be preemptively cutting rates. This is something from the Atlanta Fed, which this is the Atlanta Fed. From the Fed, their GDP forecast for Q1, which GDP is growth in the US. If you go back to your macroeconomic days, right, your GDP, gross domestic product, showing you how much the US economy is growing. Well, the forecast for Q1 is negative 2.2%. But then when you factor in the impact of foreign trade in gold, it's negative 0.1%, at least the forecast from the Atlanta Fed. So they think we're going to see either flat or potentially negative GDP growth. If we see that, that's certainly a big indicator that we could be headed for a slowdown in a recession. And this is also Q1, where there was a lot of pull forward of demand. All of the people out there that saw tariffs happening, and you could see this in the different reports out there, they brought demand forward and bought things like cars ahead of the tariffs and other items. And businesses loaded up on inventories as much as they could ahead of the tariffs. Even with that, which oftentimes can help GDP to be higher, this is what they're forecasting, negative 0.1%. But what does that mean behind it? If you pulled the demand forward, you'd have to expect that we'd see maybe even more weakness behind it. Now, the rule of thumb used to be 2 consecutive quarters of negative GDP as a recession. It no longer is. They've changed their definition per se, and they moved the goalposts a little bit. But if we start seeing negative GDP numbers or flat, which is still not good, I'd imagine the Fed's going to change their tune and change their tune very quickly when it comes to cutting rates. Our forecast is that the Fed's going to end up cutting about 4 times this year. I think really realistically is 3 to 4 times, especially if we see a recession. What does all this mean for mortgage rates? Because a recession on one hand, if we see that or if we're in one, it sounds scary. And we're going to talk about how this relates to housing as well. But during recessions, inflation comes down, there's less demand, there's less buying, the unemployment rate goes up, and the silver lining is mortgage rates always sharply decline. Mortgage rates, I think, are going to trend lower this year. And we have an administration in place that wants to see lower long-term yields. This is my father, Barry, here. He gets a chance to talk with some pretty cool people. And he, right here, had a conversation for about 20 minutes with the Treasury Secretary, Scott Bessent. And he said he wants to unfreeze the housing market, and he wants to see 10-year yields lower. Can he do that? What are his options, or how may he be successful in doing so? When they issue debt, the way that right now the U.S. is at a deficit, which means that we are spending much more than we're taking in through taxes and tax receipts. So that's deficit spending, which means our debt level continues to rise. How do we come up with this money? We issue debt. Our Treasury issues treasuries that are then sold at auction, and that's our debt. If you issue short-term treasuries, they don't have as much of an impact on mortgage rates. If you're issuing 10-year treasuries or 30-year bonds, that has more of a direct impact because that is supply that has to be absorbed by the market. And there's always an equilibrium price or demand at some point, but sometimes that demand to eat up that supply is at a lower price, which means it's inversely correlated with the rate. A lower price means a higher rate. So Scott Bessent told Barry, maybe he's going to focus more on issuing short-term debt as opposed to long-term debt. That should help and provide more scarcity of longer-term paper. The balance sheet. This is something in conjunction with the Fed. The Federal Reserve has been reducing their balance sheet. And without getting too deep on this, what it means is they've been allowing their trillions of dollars of mortgage-backed securities and treasuries that they hold, they've been allowing them to mature, or when they receive money through principal payments or somebody sells or refinances their home, they receive that money and they've been allowing it to fall off the balance sheet. So over time, their balance sheet has been declining. Well, they recently just reduced how much they're going to allow to run off. So they are only going to allow $5 billion in treasuries to run off, which means essentially they're going to be buying $20 billion a month in treasuries through what's called their reinvestments. But that means that they're going to be somewhat stimulative to the treasury market, and they're going to be eating up some of the supply of treasuries out there. That should help bring rates down, especially if the reinvestments are in things like 10-year treasuries or 30-year bonds. And Scott Bessent said that he's going to be working with the Fed to make sure they are skewing it more towards the reinvestments in things that will help the 10-year and mortgage rates. He also feels that bank deregulation, which they're working on currently, is going to help to reduce mortgage spreads. There's always a relative relationship between the 10-year treasury and 30-year mortgage rates. 30-year mortgage rates right now are about 2.5% above the 10-year treasury. That's a wider than normal spread. He thinks with bank deregulation, once that gets done, it's going to narrow the mortgage spreads to the 10-year. That is something that can help rates to come down. It means that you might actually see mortgage rates on a relative basis come down a bit faster than 10-year treasury yields. And DOGE, the debt that we are issuing, the irresponsible spending that we're doing, we have to issue more treasuries. That, again, has to be absorbed by the market. That additional supply, it can cause rates to move higher. DOGE, this is Barry here speaking with Elon Musk. DOGE believes, and Elon Musk believes, that they're going to be able to cut spending by $1 trillion through this. Now, I'm not sure if that's real. I'm not sure if he's going to be able to do it. But to any degree that they're able to significantly cut spending, it means less issuance, and it means that we are going to have a more favorable mortgage rate environment. Here's this chart that I was explaining about mortgage spreads and the 10-year treasury. I want to give you a forecast on where I see rates going, but I don't want to just give you a number. I really want to walk you through and hold your hand and explain to you how we are thinking about things. So the normal difference between 30-year mortgage rates and the 10-year throughout history, you can see the green bars, it's about 1.6 to 2% above the 10-year. Right now, it's actually around 2.5% as of today. That means 30-year mortgage rates are 2.5% above the 10-year treasury. And this has come down. Back in October of 2023, it was 3.1%. That was where mortgage rates were above 8% and the 10-year was right around 5%. There's periods of time where this spread widens, and then there's periods of time where it narrows. What causes this? Well, it's a bit technical, but you guys have probably heard the term of servicing. That's somebody that literally services the mortgage. They send you the statements, they send you a nasty letter if you're late. Well, the way servicing works is you either do your own servicing as a mortgage company or you pay to acquire the rights to service the mortgage. And the longer it stays on your books and that person doesn't refi or sell their home, the more money that you make. When rates are moving higher and rates are at 8%, this is where the spread was the widest. Do you think the chances that as soon as rates move lower, somebody's going to refinance or higher? The answer, of course, is yes. And servicing is one of the things that goes into the value of a mortgage and hence influences the rate. Well, when rates are really high and they're expected to come down, there is a huge prepayment risk. And that means that almost all of the servicing value in the mortgage gets sucked out. But as rates come down, servicing value begins to re-enter because there's less and less and less chance of prepayment risk. And that causes the spread to narrow. So as we see bank deregulation, according to Bessent, as well as rates continue to come down and servicing values get back into the picture, you will see those spreads narrow. And the 10-year, if we want to talk about a specific target for that, right now it is at 4.39%. Technically speaking, in these charts, we think that the first target that's realistic to hit is 380. But we see it potentially this year going down as low as 360. So what does that mean for mortgage rates? Well, we just talked about the current spread at 2.5%. So let's say the 10-year got to 380 and the spread narrowed from 2.5 to 2.25, which I think is very realistic, puts you at around 6% for our target for mortgage rates this year. Not 4%, but guess what? We don't need that. We have proven and seen that any drop in rates is very stimulative to activity. But back in August and September of last year, rates came down to, in some cases, the high fives, but the low sixes. And what happened? We had an explosion of activity of refinances as well as purchases. The only problem is it was short-lived. Many people were reactionary and they didn't maximize the opportunity. So I really believe that with the help of your Neo mortgage professional, you'll be able to maximize that. But I see rates coming down to 6%. And what that means is I think we're going to see a lot more activity than we're currently seeing. For real estate, I think the real estate market is healthy. And just to give you an overall bird's eye view of it, there's 136 million households in the US, 91 million are owned, 45 million are rented. Now, obviously, if you're renting, you don't have any equity, but those owned, there's 37 trillion in total equity. On average, each household has about $407,000 in equity. And of the 91 million owned, 35 million have no mortgage. They're free and clear. And the equity on that is 20 trillion, or on average, 571,000 per household for these 35 million households. The mortgaged properties is 56 million. The total equity is 17.3 trillion, and the average per household is 311,000. And by the way, the amount that's tappable that you could use in, let's say, a cash out refinance is over 200,000. So people's balance sheets on their homes are extremely healthy. What's going to determine the future of home prices? It's pretty simple. Sometimes people like to overcomplicate things, but like most other things, it's going to come down to supply and demand. Well, let's look at demand first. And demand can be measured in a few ways. I think the best one is by looking at something called household formations. So what's a household formation? You have mom, dad, and kid living at home, and they're in one house. The kid grows up and he moves out. It's still the same family, but now you have created an additional household. If you have a married couple living in one home and then they get separated, now you're creating an additional household. So this is your demand component. And while it's volatile, over the last 5 years, the average amount of households created per year is 1.8 million. What about supply? Well, you could look at permits because that is the most forward-looking number. But permits don't always get done, especially with the tariffs and the estimated $10,000 increased cost or so to now build a new home. So I like to look at housing starts because ground has been broken, construction has started, and I think that's a better figure for what the future incoming supply is going to be. The latest number we got last week was 1.32 million. So look at those numbers. Demand 1.8 on average, supply 1.3. There's still more demand than supply, and that is going to be supportive of home values. And it's tough to bet against the champ, which is the housing market. There's been 77 of the last 83 years where home prices have gone up on a year-over-year basis. And the vast majority were concentrated where? In the housing bubble years. And it's a very, very different environment than that time today. It's been a very good decision to buy at any time of the year over the last several years. But there's specific times that I'd be expressing to my clients right now where you can be even more opportunistic and really even have the best timing. And when is that? Well, on this chart of home values, you could see the acceleration happens at the same time every year. When is it? It's right now. It is March and April in the beginning of the spring home buying season. So while it's always been a good idea to buy a home, it is the best time to be buying because of seasonality and opportunities right now. How about if we see a recession? There's a lot of people that are fearful of buying a home because they hear there's a high probability now of a recession, especially depending on what happens with these tariffs. And I can understand why. Because during a recession, unemployment rate always goes up, which means people lose their jobs. And if you lose your job, you can't buy a home, right? But on the other end, for every 1% drop in rates, 5 million more people are eligible to buy. So there's a counteracting balance there. And almost always you see more people on the latter end of that equation, which always provides more activity. And home values actually counterintuitively do very well during recessions. Just look at this chart. This is home values. And these gray bars here are recessions. Notice how during the recession and after, home values always rise. There's one exception right here, the housing bubble. But this is fog up a mirror, 580 FICO, no income, no assets, no problem. Like in the movie The Big Short, you had the go-go dancer with 5 homes and a condo. It's completely different now. And you had a different dynamic with supply and demand. You had 4 million existing homes for sale. You had 2 million homes a year being built by builders, the most in history, and not enough demand and crazy loans being done. It couldn't be more opposite today. I think that if we do see a recession, we're going to see rates fall, and I think housing will still perform well. Our forecast is for 4 to 4.5% appreciation. You need to illustrate and quantify this, and your Neo Mortgage Professional can help you do it very, very easily for your listings and provide this for you for your open houses. If you see 4% appreciation on a $500,000 home, it doesn't sound that exciting. $20,000 you would gain in 1 year in appreciation alone. So just to recap our forecast, 4.4% unemployment rate, and it could be higher if we're in or going into a recession. Core PCE, we think will come down to 2.6%, not quite at the Fed's 2% target, but if it comes down to 2.6, that will help rates a bit. The Fed funds rate, we think we're going to see 3 to 4 cuts this year. And our target for mortgage rates is low 6s, and that is going to provide a big uptick in activity. And appreciation, we think home values on average across the nation are going to rise by somewhere between 4 and 4.5%. So hopefully some of these market insights give you that market expertise that you can utilize with your customers. Listen, I don't know about you guys, but I've never heard a customer say, not ask, hey, is now a good time to buy? And what's happening with rates? And a lot of people might answer that in a cutesy way and say, oh, yeah, it's a good time to buy. And boy, if I knew that, I'd be on a beach somewhere drinking a pina colada. But you can answer that question. And the person that answered it that way, they just blew a great opportunity to show their expertise and build trust and ultimately win that customer and increase their conversion and close more of the opportunities that they already have. And your Neo Mortgage Professional can certainly guide you. They are the most scripted, smartest group I think that I've ever worked with. So make sure you have them helping you speak with your customers about the opportunity that exists right now. And they are also plugged into the market. They are on this. And listen, it's tough to always be the lowest rate. But what's more important, the rate that you quote somebody or the rate that you close at? It's the rate that you close at. So while maybe you don't start out at always the lowest rate, what are you getting executed at? Well, Neo is plugged into the market. They're following this stuff every single day like a hawk. And look at how they've done for their customers. They locked at the peaks of the market in almost every single scenario. If we look at this example right here, mortgage-backed securities rose by 309 basis points. That's about 0.75% in mortgage rate, if the equivalent. Maybe somebody could be 0.25% lower than you, but if they locked right away and they didn't capture this, they actually ended up giving that customer a rate that was 0.5% higher. So market expertise and timing is critical, and there's nobody better at it than Neo. And I want to just quickly show you some of the tools here that we have. And Josh, I know I'm going a little bit over here, brother, but the biggest challenge you might be faced with right now is people just simply wanting to wait for rates to come down before buying. So how do you overcome that? Some people say you should marry the home and date the rate, meaning buy the home today, refi when rates come down. That's all well and good, but if you don't quantify it or illustrate it, it's just a cute saying. And Neo has tools exactly like the one I'm going to show you that I would be bringing to every open house, every listing appointment, because you have to explain how when rates fall, there's more eligible buyers, there's less choices because there's more demand, the tight inventory scenario gets tighter, and it applies upward pricing pressure. So counterintuitively, the higher rate can actually be their best friend and give them an opportunity to purchase with better negotiation ability. So here's how the tool looks that they can create for each one of your properties. $700,000 home, they could decide to buy it today or wait a year to buy it, let's say. 20% down, the rate is 6 7/8. Their total monthly expenses is $5,075. On the other hand, they could wait. And let's say they're right and rates come down by 1% next year. Well, there's going to be some interest savings, clearly, but it's not as much as you think because people don't factor in how much homes are going to appreciate. And Neo has the numbers for every single zip code in the country. And if they want to keep the same loan to value and home values go up by 4.1% in that market, they're going to have to take out a higher loan amount, which eats into the savings of that 1% decline in rate. But there is a cost of dating the rate. It's $182 a month. And you're going to pay that every month for the next 12 months. So it's going to cost you $2,184 more versus waiting for rates to come down 1%. But the relationship just begins when the Neo Mortgage Professional is working with the customer, because they're going to be monitoring this. And as soon as rates come down and it makes sense, they're going to refi them. But there's a cost for that. For this example, it's $3,500. So the cost to date the rate is $5,684. That's a pretty expensive date. But the benefit of marrying the home is 4.1% appreciation on a $700,000 home, which equates to $28,700. So you put it together with the costs, you are better buying today versus waiting a year for rates to come down by 1% by $23,000. And if you can illustrate this and easily share it with your Neo Mortgage Professional, which, by the way, they can create this for you, co-brand it with you. It's beautiful. I can't tell you how many real estate agents have talked to me, emailed me, and said that this tool alone was enough to get the customer off the fence and commit. Now, there's tools like this for every scenario that your Neo Mortgage Professional can create. One is the buy versus rent, which I love because the media is not our friend as far as deterring people from buying homes. The latest articles I'm seeing is it's better to rent in every market in the country instead of buying. Well, really quick, $500,000 home, 10% down, 6.5% rate. The payment's $4,200. If you're going to rent a similar home, it's $553 cheaper in this market. Well, that's where the media stops. But you have to factor in other things. Rents on renewals, they go up. And how about on the home? Let's factor in the negatives, show some vulnerability. Property taxes go up. You have repair costs that you don't have if you're renting. And when you sell the home, it's going to be a 3% cost on the future appreciated value, but you have to factor in the appreciation too. And in this market, 4.2% per year over the last 63 years. The forecast, 4.1% over the next 9 years per year. So you put it all together. Yes, initially, the cash flow is $553 a month cheaper to rent versus buy. But this shows you on the left the monthly payment to buy, the one on the right is to rent, with the rental increase. In this example, by year 4, it's close. By year 5, it's actually more expensive to rent. But part of your mortgage payment is principal. That's not a cost. That's your own money. And that's the black shaded area. When you factor that in correctly, by year 2, it's close. By year 3, it's actually more expensive to rent. And after 1 year, or I should say after the 9 years, total cash flow, you're actually cheaper buying versus renting in this scenario by $21,500. And the principal you gain after 9 years is almost $60,000 as you pay the loan down. And the 4.1% appreciation is life changing because guess what? You'd gain $220,000 in appreciation. There's a tax benefit of buying versus renting. And let's factor in the big negative cost to sell. You put it all together, the media says $553 a month cheaper to rent. But if you look at everything correctly, you're $286,000 better off buying versus renting after 9 years. As long as you're in the home for more than a year, you should be buying. There's a reason why homeowners, on average, have 42 times that the net worth of renters. Now, I'm not going to have time to go through this debt consolidation tool, but just know this. If one of your biggest challenges is the lock-in effect, people want to move, they had a kid, they want a bedroom, but by the time they get the more expensive home, they get one of those things in the higher rate, it's $2,600 a month more expensive. Doesn't make sense. What does everybody do? They sell their current home. They take the proceeds after what they owe, and they put all of it down. But people have a ton of debt today. So they'd be better served, and your Neo Mortgage Professional can guide them through this by putting less down, paying off all those debts, and looking at overall obligations. Instead of it being $2,600 more expensive to get into the home of their dreams, maybe it's $300, $400, $500 more expensive. And that can help you get the deal done and help the customer ultimately get what they want. The last thing I want to share with you is something that I think is really special that your Neo Mortgage Professional can provide for you. There's going to be a lot of opportunity ahead, team. You need to stay top of mind and in touch with your customers. What better way than every month to send them something that shows the value of their home and the future opportunity? It even teases all the listings in the area. There's a readiness to move score. They can essentially let you know if they're looking to maybe buy another home. And the best part, Neo's providing this for you completely free of charge. All you have to do is talk with them. You can pair with them, upload your database, and this gets sent out automatically. The open rate on this, on average, is 80%. It will do an amazing job of keeping you top of mind for the next opportunity. The other thing, you may have heard of List Reports because List Reports is very popular. Agents always love it. It really handles the majority of your marketing needs. Well, if you pair with a Neo Mortgage Professional that invited you to the call, it's again completely free for you. But here's what happens. Every day you get an email. It gives you social media graphics, checks that box for you. Local market graphics that you can share for your markets that you do business in. A ton of great insights. And then anytime you get a new listing, within an hour, you're going to get 25 pieces of co-branded marketing content without having to do anything, absolutely free. Open house flyers, property websites, marketing kits, social media posts, lead generation text codes, you name it, you're going to get all of it if you pair with and work more closely with your Neo mortgage professional. Josh, I apologize so much for going a little bit over there, brother. But you take it away, my man.
Dan, you are absolutely on fire. That was so much value. Thank you so very much. And, just looking at the detailed analysis that you do, there's no wonder why you guys are 4-time Crystal Ball Award winners, because you really dig into all the underlying factors that are impacting mortgage rates and impacting the housing market. And even though, me, like many people here, probably didn't understand every piece of the nuance, the story that you built as to how you come to your conclusions is fantastic. So thank you.
And Josh, I just wanted to let everybody know I'm going to remain on the call, but I have a 2-month-old son, and my wife's going to kill me if we don't go take him to his doctor's appointment. He's getting all his shots today. So I'm going to join from the phone, but I will still be here.
All right. Very good. Thank you, Dan. Appreciate it. All right. I want to spend the last 10 minutes that we have together, and I want to act as your coach and your advocate. I want to encourage you to think about how we can use the information we just learned from Dan to increase your business for the rest of 2025. And there's a couple of things that came to mind that I want to share with you. I'm going to share my screen really quickly. This is what's going through the mind of the consumer. And as Dan said, it's not enough just to say, hey, now's a good time to buy a home. We need to have the data, the analytics. That's why we subscribe to MBS Highway. That's why all of the mortgage advisors at Neo watch the daily update every day. So we can answer that question, is it a good time to buy a home, with actual data. Hope everybody can see my screen clearly, because I lost other visual.
We can see it perfect.
Thank you. Okay. This is the kind of negative news media that our buyers and our sellers are receiving. And we have to be able to counter this kind of stuff and explain it as real estate and mortgage professionals. So I'll read it from the top, from the Kobayashi letter. U.S. existing home sales are set to close at 4 million in 2025, marking the worst year in existing home sales since 1995. Sales are set to be even lower than during the 2008 financial crisis. That's unbelievable. The lack of demand in existing homes comes as home prices have jumped over 50% from 2020. And over that same time period, mortgage rates have nearly tripled, making affordability even worse. I'm getting depressed just reading this for a second time. And the average rate on the 30-year mortgage is up 100 basis points, or 1% since September, to 7.1, despite the Fed cutting rates by 100 basis points. The housing market is frozen. And what makes this graph even crazier to me, not only did we sell less homes than we did in the Great Recession, we had to go back to 1995, but if you think about the population growth, in 1995, there's only 266 million Americans in this country. Today, it's closer to 342 million Americans. So that means we have a 28% increase in population since 1995, and we still sold less homes than we did in 1995. So where are all those people that didn't buy or sell real estate in 2024? They're your past clients. They are our clients that we've put into homes, and there is an all-time high in pent-up demand. They've outgrown their homes, or they bought during the COVID years and they have regrets because they had to make a decision because there was 12 other offers, and there's pent-up demand to move to the home that they really want. Many of them have to go back to work in the state where their actually jobs are. But what is holding them back? 7, and as we saw in last year, the beginning of last year, even 8% mortgage rates at times. So as mortgage rates come down, that frozen housing market, as the Kobayashi letter points out, will start to thaw. So the question I have for each of you is, when is the time to re-engage your client database? Is it when mortgage rates hit 6 and the high fives and people are all over Zillow and they're looking for properties? Or is it now? So I want to give you a couple of tools that Dan mentioned that I think you can use very effectively to create value, to re-enter that relationship with your past customers. And, I think Dan did a wonderful job pointing out that tool of the home report. As Dan said, this is something that can be co-branded and sent out for you. This is an actual customer of mine that I helped buy a house for $400,000 in 2023. Today, their value's $456,000, and they put a sizable down payment. So they have $196,000 in equity, and it shows a forecasted value. Like Dan said, you can go into the markets and check what's going on in the local markets. You can see all the active and pending listings. And most importantly, what I think is very, very valuable about this tool is they can say, hey, I want to upgrade. I need to move. And, this is the timeline. Get in touch. Boom. And this is going to send me a message that it's time to connect with that client. We need to be thinking about how can we leverage technology so we can speak one to many, meaning me and you, to your big, vast client database, and how can we do it cost effectively? This is something that your Neo Mortgage Advisor has already subscribed to and pays through the MBS subscription. And if you want to co-brand that to your past client database, it's a great way to get connected with them. And then I'm just picking up the phone. When I see people open these emails that has an 80% open rate, I'm just picking up the phone and calling them and saying, hey, saw your Wealth Digest. Can you believe you have $193,000 in equity? Congratulations. What's going on with Stephanie? And we get right back into the flow of that relationship we had as I was guiding and helping them through their mortgage transaction. So that's something I want everybody to consider on this call. And then just for fun, because one of the things we're doing at Neo is we're really getting curious around AI. And I just put this prompt in today. I said, hey, I'm a realtor who's not made significant effort to stay in touch with my clients after they purchase their home. Provide ideas on how I can reconnect and rekindle my relationship with clients without seeming creepy, desperate, or salesy. Because I know when I have resistance of calling clients that I've helped in the past, it's because I don't want to feel desperate. I don't want to feel needy. This is so cool. All right, here's reconnect idea. You can send a simple home anniversary note. Hard to believe it's been 1, 2, 3 years since you got the keys. Hope you're loving your new home. Just checking in market update. That can be done through the home report as I just showed. Homeowner tips newsletter, seasonal maintenance tips, etc. Pop-by gifts, invite to something cool. You cross my mind. I just happened to be in your neighborhood showing another family a home and I was thinking about you. How are you loving your home? Client social events, ask for local recommendations. Hey, I just helped a family in your neighborhood. Do you know a good maintenance man that's been helping you or somebody with lawn care? So my point in sharing this with you, because none of this stuff is revelatory, but my point in sharing this with you is as the mortgage rates come down, as the housing market thaws, all this pent-up demand is going to come back into the real estate market. And you can decide right now, are you going to get in front of that movement or are you going to be reactionary to that movement as mortgage rates come down? So in closing here, I hope that you will connect with the mortgage advisor who invited you here. Thank them for paying all of these professional analytic tools on your behalf for you. And ask them how you can partner to re-engage your client database because the market is thawing and it is time to take action before those buyers hit the market without you. Dan, I'll leave you with the closing word, my friend.
Team, thank you for staying on and for joining us today. I hope that it was valuable, but a couple just takeaways is number one, listen, I know it's been difficult the last few years, but I truly think that, number one, if you're still here, you're one of the survivors. And there's some benefits where a lot of your competition has gone by the wayside. But I really, truly think that things are going to get better. And as I mentioned, I see interest rates trending lower. I think we can get to the low sixes this year, which will provide a big boost to activity. And I also think housing is going to remain strong. And you need to really express the financial opportunity, but also use your resources, use your Neo Mortgage professional and the tools that they can provide you, because it will help you to generate more income and get people off the fence. The cost of waiting tool, list reports, the home report, all of these things completely free to you. All you have to do is make sure you're working closely with your Neo mortgage professional.
Nailed it. All right, everybody, a round of applause. Look at this guy. He did an incredible keynote presentation, and he's going to make it on time for his 2-month-old son's doctor's appointment. I want to be Dan Habib when I grow up, everybody. Thanks for joining us here today. And Dan, you're a stud. I appreciate you sharing so generously.
Thank you, guys.
Thanks, everybody. Have a great rest of your day. Get after it out there.